Hello and welcome to the latest On The Money podcast, which is a weekly look at how to make the most out of your savings and investments. In this episode, the focus is on what the US election result means for investors, and joining me to discuss this topic is Richard Hunter, Head of Markets at Interactive Investor. Firstly, a little bit of housekeeping. We're recording this episode on Friday, the 8th of November, so a couple of days after the election result, and we'll be talking about how markets have initially reacted. So Richard, we know the result. Donald Trump is back in the White House. However, at the time of this recording, we don't know yet whether the Republican Party has took control of the House of Representatives, but it is currently leaning that way. If successful, that'll give the Republican Party a clean sweep of having control of the House, the Senate, and the White House. By having all three, it'll be easier for Trump's policies to be given the green light. And this potential clean sweep was reflected in how both equity and bond markets have initially responded to the US election result. So Richard, could you talk us through how markets have initially reacted?
Yeah, the initial reaction, straight after the news, the first chance they had to react to this news, was extremely positive. The three main indices were each up by between 2 and 3%. The Dow Jones climbed by over 1,000 points. And each of those three main indices, the Nasdaq, the Dow, and the S&P 500, hit new record highs. In the following day, on the Thursday, the Nasdaq and S&P 500, which obviously are more technology focused, continued to climb to new record highs, whereas the Dow Jones was basically unchanged. But quite apart from that, outside of the main indices, the possibility of lower tax rate and less regulation pretty much meant that the tide lifted all boats, because the small cap index, just after the announcement of the election, was also up between 5 and 6%. So at this very early stage, there has been nothing but a positive reaction from US investors.
And while it was a positive reaction for equity markets, the bond market did experience a pickup in volatility when it became clear that Trump was on the verge of victory. So 10-year Treasury yields, which are a key benchmark for the global financial system, rose to almost 4.5% when the result was confirmed, whereas a day earlier, yields were around 4.15% when voting was still taking place. And of course, rising bond yields mean that bond prices fall. So why did this happen? Well, the bond market has moved to price in the prospect of higher borrowing and higher inflation. And the prospect of both of those things dominated my inbox from fund managers following the result. One of the comments I received from Mitch Resnick, who is Group Head of Fixed Income at Federated Hermes, he said, US bond yields rose to reflect an administration that is perhaps relatively more deficit agnostic than the alternative. He also said, as deficit relative to GDP in the US increases, the cost to borrow rises, hence the widening. So Richard, we've talked about how both equity and bond markets have initially reacted. Could you talk us through how the US dollar reacted?
Yes, it reacted strongly as well. And of course, the currency market is very much a fixed, and one of those markets where if something goes up, something else will go down. So that weakens sterling, for example, the euro, etc., etc. There's a few reasons for that, but I think mainly the fact is that the higher inflation you just mentioned could in due course, of course, relate to the Federal Reserve slowing down its reduction in interest rates, notwithstanding the fact that the largely expected 0.25 percentage point cut happened yesterday. But one of the impacts of that is that in theory, of course, a weaker sterling, for example, should be something of a boost to the FTSE 100. It's estimated around 70% of earnings come from overseas, and a large proportion of that from the US. So with a weaker sterling, those earnings are more valuable when they're repatriated to the UK. That being said, after an initially strong reaction, the UK markets have subsequently given up those gains and struggled to make much progress. And I think one of the reasons for that, it remains to be seen how much of this is bluster from the new president, is the threat of tariffs of up to 20% on Europe, but up to 50 or 60% on China. Obviously, tariffs coming the UK's way. After Europe, the US is our second largest trading partner. And again, that could actually turn out to be inflationary for the UK just at a time when we're starting to get that particular beast under control.
I agree, Richard. The proposed tariffs and their potential impact on inflation is certainly an area to watch. In particular, tariffs on electric cars made in China are expected to increase. Comments that dominated my inbox, Richard, from fund managers pointed out that one of the areas of the US stock market that could benefit from Trump's policy of promising to lower corporation tax is US smaller companies. What's your thoughts on that?
Yeah, very much so. I mean, you've got something of a sweet spot for US smaller companies at the moment, quite apart from the fact that, as you say, they could effectively be receiving some stimulus from some of Trump's measures. We've also got interest rates now on a downward path. We're not sure what speed the Federal Reserve is going to now do that, particularly if the Trump stimulus comes through. But nonetheless, that means that borrowing costs are lower. And of course, for smaller companies, and to some extent mid-sized companies as well, they rely much more on borrowing to grow their businesses until they get to the certain level where it can be self-perpetuating. So again, in the initial stages, investors have chosen to say that this is positive for small and mid-cap, which isn't necessarily a bad thing, of course, because one of the things that has been overhanging the US market for a couple of years now is this concentration risk and the US market's reliance, particularly on the Magnificent Seven, to be driving a lot of the gains. So in growth terms, the story is more diversified. That should give some more investment opportunities.
And of course, medium-sized and smaller businesses, they have greater sensitivity and revenue to the domestic economy compared with more internationally integrated larger companies. A fund that our analyst team like for this part of the market is Artemis US Smaller Companies Fund. It's managed by a fund manager called Cormac Weldon. He's managed the fund for over 10 years. And there's a co-manager as well called Olivia Micklem, who's been co-manager now for a couple of years. I think the US stock market is a really tough market for active fund managers to gain an edge. But this fund does have a strong record of beating the market over the long term. And according to our analyst team, the fund is in a good position to benefit from US domestic growth. Richard, are there any other policies that Trump has promised or pledged that you think could impact certain sectors for better or worse?
Yeah, I mean, we're now at the situation, as we've been discussing, that it's pretty much each area of the market which is seeing the benefit of what could be lower taxes, lower regulation, etc. Concerns will come further down the line, of course, that an already large deficit will balloon further, and some of his impacts of his measures could well be inflationary. But in the meantime, it's very positive, and based on past experience, you could quite easily see that the infrastructure sector, for example, could benefit as Trump gets out the checkbook and continues to put some more life into the building sector as a whole in the States. And also, and unfortunately from a human perspective, but more positively from an investment perspective, I don't think there's going to be any possibility of defence spending in the US slowing down anytime soon. Beyond that, the consumer's an interesting one. The US consumer accounts for about 70% of economic growth in the States. And the US economy isn't actually in a bad place at the moment, but there seems to have been a rift opening up. And perhaps one of the reasons why Trump got back in, between what Wall Street is seeing and what Main Street is feeling. And one of the strands of his campaign was around, do you feel better off than you did a couple of years ago? So needless to say, if the consumer is energised by his very presence, let alone lower taxes and all the rest of it, and that results in a higher consumer growth, that will give the economy an initial burst, although by the same token, of course, more buying, prices potentially go up, and there's another source of potential inflation.
And just to add one final thought, due to the fact that I saw some fund managers comment on this, is that during the campaign, it was quite clear that Trump was supportive of the oil and gas industry. However, he does appear to be less keen on renewables. So that those are potential other areas to watch. You touched on this earlier, Richard. I thought we wanted to next talk about what your thoughts are on the prospects for the US market as a whole. As you've mentioned, the initial market reaction to the US election, there was definitely an element of a rising tide lifts all boats. But the big question going forward is whether this rising tide is sustainable, given the valuations for the US market are much higher than other regions, particularly our own stock market here in the UK. What are your thoughts on a sort of more medium-term view, Richard?
It's interesting that probably the main concerns which have overhung US markets this year, despite the fact they've managed to crawl to all-time records on many occasions over recent months, has been that, as we've mentioned, you've got this concentration risk. There is no question that valuations are starting to get a bit stretched. And of course, the other concern was around the US economy and whether the Federal Reserve could engineer a soft landing and avoid recession in the States. This will muddy the picture somewhat. On the simple basis, we are potentially now going to see a raft of stimulative measures which could put the US economy into a new era of growth, with obviously the longer term implications down the line. The interesting one has got to remain the tech sector in particular. It's been a major driver of growth. And as we've seen over the last couple of weeks, if there's any sort of disappointment, the likes of Meta Platforms and Microsoft spring to mind, their shares are slightly punished. That's not to say, of course, that they haven't still performed strongly this year, but what it does say, as we've seen indeed with NVIDIA, that expectations are getting progressively higher with those higher valuations and share prices, and that bar, therefore, becomes increasingly difficult to scale.
And for investors that are concerned about the concentration risk of the US stock market, I mean, as mentioned earlier, one area you could focus on is US smaller companies. But if you want to own the market, you could consider an equally weighted exchange traded fund, an ETF. So the Magnificent Seven accounts for around a third of the S&P 500 index. However, if you pick an equally weighted index, it holds each company in equal proportion. So, for example, an equally weighted FTSE 100 index would have a 1% weighting to each constituent. And one of the main benefits of an equally weighted ETF is that it avoids investors being overexposed to stocks that have potentially become overvalued, or worse still, potentially part of a bubble that will pop at some point. And an equally weighted index, it also gives investors exposure to parts of the market that have performed less well in recent years. And going forward, if there is a broader set of winners in the US market, then in theory, an equally weighted ETF should perform better than the more common market cap weighted approach, which most index funds and ETFs invest in. So under the market cap weighted approach, this means that companies are weighted according to their total value relative to the index. So if NVIDIA is 7% of the S&P 500 index, then the index fund or the ETF will have 7% exposure. However, there's not a lot of choice in terms of an equally weighted approach. Just to give you a couple of examples, 2 examples on Interactive Investor are the Invesco S&P 500 Equal Weight ETF and Xtrackers S&P 500 Equal Weight ETF. So for those 2 ETFs, every individual share will generate 0.2% of the returns achieved by the ETF as a whole. Now, of course, while equity markets have initially reacted positively, the expectation is that over the coming months and over the next 4 years, it's expected that geopolitical risk will increase under Trump. Now, Richard, for investors, political risk is something that cannot be controlled. And I think the message is that for things that are outside of investors' control, it's key to stick to your long-term investment strategy rather than making any knee-jerk reactions.
Yes, I think you're absolutely right. And that includes the initial reaction to the election as well. Ultimately, of course, as an investor, you like to think that the world will be a better place in 5 years' time or 10 years' time, whatever your time horizon is, and that companies will have continued to increase their profits in the meantime. Now, the other thing to say, I think, on this particular point is it depends where you're invested, because we're already seeing, and we're like to see a lot more of this, that President Trump's focus is very much going to be on the US domestic economy, potentially at the expense of others. Even during Biden's time, the US relationship with China, for example, remained extremely fractious, and there's certainly no signs that that will change. So that immediately, of course, puts China in the spotlight at a time when it's trying to revive its own economy with various stimulative measures. There is an interesting aside, which we're not going to know for some time, and it will depend on A, the amount of the tariffs, but B, when they also kick in, US tariffs on China, is whether the US is effectively restricting its own supply chain by not dealing with China, which of course itself could be inflationary, let alone cutting off potential area of lucrative growth from the Chinese themselves. So it really depends where you're invested. I think the FTSE 100, in theory, should quite simply benefit from the strength of the US economy and other parts of the world as well, simply given its international exposure.
And it also depends on your time horizon as well. If you can invest for the very long term, then election results tend to have little impact on investment returns. To hammer this point home, I was sent some very interesting statistics from John Plassard, who is Senior Investment Specialist at Mirabal Group. He pointed out that a $1,000 investment in the S&P 500 in January 1950 with dividends reinvested would be worth it'd be worth over $3.5 million today, which is a startling figure. And he says this figure shows that investors should not base their strategies on election results, but rather take a long-term view. My thanks to Richard, and thank you for listening to this episode of On the Money. If you enjoyed it, please follow the show in your podcast app and do tell a friend about it. And if you get a chance, leave us a review or a rating in your podcast app too. You can join the conversation, ask questions, and tell us what you'd like us to talk about via email on otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your investments on the Interactive Investor website at ii.co.uk. And I'll see you next week.